Okay, so in this video, I'm going to be sharing with you an alternative way to trade the wheel strategy that is going to help you feel psychologically better, especially if the market is crashing like what he has done over the past few weeks, thanks to Donald Trump and his tariffs. And it's also going to help you get a larger profit on the way down as well, especially if it goes past your cash secured put. So as you probably already know, the traditional way of trading the wheel strategy is by selling the cash secured put and the covered call as well. So one of the issues of trading the traditional wheel strategy, where you start off with the cash secured put, is that if the market is going to have a very big move down, like for example, like this big move over here, and it's going to crash way past your cash secured put, this is where a lot of people can panic. So as you can see over here, what I have on the chart is of NVIDIA, and I'm going to use NVIDIA as an example because this is actually what has happened to quite a number of people. So I had a number of people that actually emailed me over the past few weeks when they did the wheel strategy before the market actually crashed, and many of their cash secured put is very deep in the money and they're panicking and they can see, very huge red numbers on their platform. So is there a better way to trade the wheel strategy, especially when the market crash? And the answer is there actually is, and can be better as well psychologically. But of course, there's going to be trade-off, which I'm going to share with you a little bit later. So the traditional way of trading the wheel strategy is by selling the cash secured put first. So as you can see over here, NVIDIA, the current price is 113.54 as of this recording. So let's just say, for example, we do not mind getting assigned at the price of $100. So with the traditional wheel strategy, what you do is you sell a put option at the 100 strike price. So this is going to be your cash secured put. So -1 just denotes one option contract because each option contract controls 100 shares. So what is this alternative method that I'm talking about? So instead of just selling the cash secured put, what you can also do is to include another strategy, and that is the put debit spread. So the put debit spread over here, I'm going to just draw the structure. Basically, is going to be something like this. As you can see, you're going to be long one put option, and then you sell a further out of the money put option. This is where you get the put debit spread. So if you take a look at this structure by itself, this is what you actually call the ratio spread. So in this case, the put ratio spread. Because if I was to combine these two together, so let me just erase all this. If I was to combine those two put options together, the short put and then have the long put, this is where you get the put ratio spread, where it looks something like this. So for the put ratio spread, you typically have two short puts at one strike price, and then you have a long put at somewhere near the current market price is. So in this case, I'm just using this example down here. Now, when we are trading this strategy, I would suggest to actually split them apart. So instead of combining them to just two short puts at one strike price, you might want to have the short put for the put debit spread side on a different strike price, because we're going to manage them differently. So let me just split them up again. And this is going to be pretty important, especially when it comes to managing it. So I want you to pay real close attention to this. So in this case, the put debit spread, the short put of the put debit spread does not exactly have to be at the same strike price of the $100. It can be above it. So in this case, I'm just going to show the put debit spread that is going to be slightly above this 100 strike price. So maybe it's going to be like $101 or something like this, right? Because again, like I mentioned, we want to manage them differently at different times. So how this actually works is that when you sell the cash secured put on the right hand side, you're going to receive some premium. So in this case, I'm going to show $3 signs in terms of the premium that you receive. Now, using this premium, you're going to use a part of it to finance the purchase of this put debit spread. So this put debit spread has to cost lesser than the overall premium that you receive from selling the cash secured put. So in this case, I'm just going to put it as $2 signs. So if you're going to receive $3 signs and you're going to, pay out $2 signs, you're going to end up with a net credit steal of just $1 sign. So later on, I'm going to go over to the option chain. I'm going to show you in terms of dollars what this is. But for now, just bear with me. So as you can see, this is how we construct this trade. You have one cash secured put, and then you have the bear put spread. So I'm going to put BPS as the bear put spread. So I'm going to talk about a few different scenarios that can happen when you put this on. So first of all, if the market does not go down, let's just say the market goes up, then you're just going to get some premium for this, because remember, it's going to be a net credit overall. As you can see over here, you still have $1 sign from the premium that you receive for the cash secured put. Now it's going to be lesser because with the cash secured put by itself, you're going to receive $3 signs. But when you include the bear put spread into this mix, then you're just going to be left with only $1 sign. So you're going to receive lesser if the market goes up. But the main problem really is if the market comes down. This is the one where a lot of people fear. They panic when the market is crashing, like what has happened over here. But once you have this put debit spread in this mix, then you're going to actually feel much better, because now with the put debit spread, you are going to be incentivized if the market goes down. And in fact, you do want the market to go down for you to capture most of the profit of this put debit spread. So what's going to happen is if the market actually goes down and it goes below our put debit spread, that means even below your this cash secured put, then this is what we're going to do. First off, we are going to close out this put debit spread, because this put debit spread right now is going to be in a profit. So how much profit you're going to take really depends on the width of this put debit spread that you've constructed. And typically, we want to look for something around 80% to around 90% of the maximum profit to take off from this put debit spread. And this amount down here is going to be more than the cash secured put premium that you will receive if you just sold the cash secured put alone. So as you can see over here, now you're getting paid for the market to actually come down because of this put debit spread. So if the market really crashes and goes below your cash secured put, you're actually not going to be panicking that much, because your put debit spread is going to take some profit over here. And then you are now left with the cash secured put. So with this cash secured put, very simply just hold on to expiration, let it get assigned, or you can roll it down at that point of time. So rolling down just simply means closing out the cash secured put, and then you bring it to a lower strike price and even to a further DTE as well. So as you can see over here, if you use the put ratio spread instead of the cash secured put on the way down, you're going to start to feel better if the market actually crashes way below your cash secured put, because that's what you want to happen. That's the only way that you can really realize a big part of the profit of the put debit spread. Now, what if now you've already taken profit on the put debit spread and now you're assigned on the remaining cash secured put? What do you do next? Well, this is where you can do the ratio spread on the call side as well. So instead of just selling the cover call, you can sell what's called the call ratio spread. So the call ratio spread is pretty much similar to the put ratio spread, only this time we are dealing with the call options. So let's just say, for example, now we are assigned on the 100 strike price on the cash secured put previously. Now we have 100 shares. So this is where you can start to sell the call ratio spread. So let's just say at this point of time, the market goes back up. Then instead of just selling the cover call, you do the call ratio spread, which is now here you sell the cover call, but you also include a call debit spread this time. So the call debit spread will look something like this. So +1 and then -1 down here. So this left-hand side, this is where you have the bull call spread, also known as the debit call spread. And then you have the cover call on the right hand side. So similarly, now you are being incentivized for the market to go up. When previously, if you sold the cover call, a lot of people have emailed me before saying, Davis, now the price is getting close to my cover call. I do not want it to, be called away. What can I do? Well, one thing is that the strategy is meant to be called away. So if the price is going to go way above your cover call, then if it's going to be very deep in the money, then chances are you're going to get a sign. But if you're going to get a sign, why not have this call debit spread help you get even more profits for this? Because if you're just going to be selling the cover call, then your premium is all you're going to get. But if you sell the cover call using the cover call premium to finance this call debit spread, this debit spread is going to give you much more profit than you would if you just have the premium from the cover call. So as you can see, it's pretty much the same thing using the put ratio spread, but this time on the way up, you're using the call ratio spread. So how exactly are you going to construct this? So let me just head on over the option chain to show you exactly how to do this. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So first of all, when you come to the option chain, you're going to be faced with a decision to make, and that is which DTE should you choose, because there are so many different DTEs. So what is the right DTE to use for this strategy? So first off, I must say that for the wheel strategy, I'm not too particular in terms of the DTE, unlike if you trade spreads, because when you trade spreads, that means you do not want to get a sign on the shares, you're just trading the options by itself. Then we want to go for 45 days and above, because that's where our edge is, where the realized move and the expected move is different, right? Most of the time, the expected move is overstated compared to the realized move, and that's why we have the edge over the long term. Now, as for the wheel strategy, because we do not mind getting assigned, I'm not too particular about the DTE. So you can go for a shorter term one if you want to, or maybe somewhere around the 45 DTE if you want as well. However, you just need to know that there's going to be a trade-off when you're trading the wheel strategy for this. And what is the trade-off? So for example, if I was to go to the 3 DTE option, you can see that if I was to go to the $100 strike price, you can see that the premium is pretty much nothing. It's only 7 cents and 8 cents. And you can't really construct a proper ratio spread using this because it's just too little. So the only option if you use 3 DTE is to go somewhere, closer to where the current market price is. That means to say, maybe you have to go for somewhere around, let's say, $109 strike price. That means if you get assigned, you will be getting assigned at a higher price compared to at a lower price. So if you are going to use the wheel strategy, obviously we do want a lower price, because this is where if you get the shares, it's going to be much better in terms of your profit if the market goes back up, right? So in this case, if you use the 3 DTE, it's going to be a little bit hard for you to find the strike price that is further out of the money, as you can see in this case. So instead, for this, you might want to go to a further out one. So let's say, for example, 45 DTE. Now, 45 DTE, this is where you can see if you go for the $100 strike price, you can actually get a much higher premium. So this is where you need to have a nice balance. So for this example, let's just say we want to go for somewhere around 1 month, around 30 days. So this is where we can go for the 31 DTE one. Now, before I get into this, I want to mention about what you see down here, this line down here. Do you see this purple line? So this purple line down here basically is telling you that there's an earnings that's coming up. So your option chain should actually tell you about this, about the underlying that you're trading. If it doesn't, then maybe you might want to consider changing another broker. But when you see this line down here, it's telling you that there's going to be an earnings announcement coming up. So the question is, for the wheel strategy, is it okay to still trade the wheel strategy even though that there's going to be an earnings coming up? And the answer is yes, because if you don't mind getting assigned already at the price that you have chosen, then this actually is going to help you. Why? Because when you have an earning announcement coming up, the volatility is going to pretty much be inflated, at least temporarily, for the news that's going to come up regarding the earnings. And when you have a higher volatility, this can give you more premium as well. So you can definitely consider using the wheel strategy, especially this version which I'm sharing with you, which is the ratio spread wheel strategy, when there's going to be an earnings. And if there's going to be a huge gap down after earnings is released, then hey, you're not too worried as well, because you already have this put ratio spread on, where you're going to be profiting on the way down through the embedded put debit spread. And you already also don't mind getting assigned in the first place. So even if it gaps down, you're not going to be worried, unless the stock selection that you choose, you're not too sure about it. So that is why it's very important to choose fundamental stocks when you're trading the wheel strategy, so that you know that at least over the long term, it has a higher probability of it going up than it going all the way down. Okay, so now I've gotten that out of the way. Let's move on to the actual selection of the ratio spread in terms of the wheel strategy. So let's go to 31 days, because that's about 1 month. So use the same example. Now, I am going to do something cool over here, which hopefully your broker can have as well, but I'm using it on Tasty Trade. And if you're on Tasty Trade, you can do this as well. You notice that at the top, this strike label over here, there's this arrow. You can actually click it, and you can see that now the ladder is flipped the other side. So you can see now that the price is actually in the proper order as in when you go and take a look at the chart, because on the chart, if you go to see it, the price is going higher on the way up. That is the normal way to look at things. But for some reason, by default, in the olden times, for some reason, this is the default, whereby as you go up the ladder, the number drops, which is a little bit weird, yeah? So I'm just going to use it. Oops, let me just open up again. So I'm going to just do it this way. So now it's going to be so much easier to see. Okay, so let's go to constructing our put ratio spread first. So as you can see over here, we will go to the $100 strike price and we're going to click on this down here. So immediately you can see that you're going to receive about $2.30 in terms of the premium. So how you're going to construct the put debit spread side is we're going to use the premium from this to finance the purchase of the put debit spread. That means to say when we construct the put debit spread, we want it to be lesser than this $2.30. So this is one way you can do it. So first you see the premium, and then now you just construct the put debit spread. So let's just say we use the put debit spread, something like this, right? So this is the put debit spread structure. So you can see over here is $1.75. So let's try and stretch it as much as we can so that we can have a very big put debit spread, which also means that if the market starts to come down, we're going to have a bigger profit as well. So you can see over here, the cost for this put debit spread is $2.10, and the credit that we receive for selling the $100 strike price is $2.30, which means to say it's still going to be an overall net credit. So I'm just going to click on the bid side down here to sell this put option. And if you want to buy the put option, by the way, you just have to click on the ask side over here. So you can see straight away, based on the credit, it shows 22 cents credit. So it means that even if the market or this NVIDIA doesn't go down past your put debit spread and it just continues to go up, let's just say, you're still going to have some profit at the end of the day. Now, of course, the profit is not going to be as much as if you just sold this 100 strike price by itself, which is going to be $2.30. But if it comes down, you're going to get much more. How much more? You can see over here, the max profit you're going to receive is around 722. But of course, chances are that we are not really going to get this max profit because we're going to exit the debit spread slightly earlier. And the reason we want to exit the debit spread before it kind of gets to max profit is because one thing you need to remember is that there is also a short put down here. And that means that there can be a chance of getting assigned on this short put as well. So the last thing you want is to get assigned on both your short puts. And this is where if you do not have the cash, then you're going to get into a margin call. So one way to kind of reduce the chances of getting assigned is that once the market comes down, and it's somewhere around 80% to 90% profit. That means to say it's not really deep in the money just as yet. Then you can close up the position. So the time where you really get assigned on this is if it's getting close to expiration date and it's going to be very deep in the money. So as much as possible, once it's somewhere around 80%, 90%, maybe even 70%, you can close up the trade for a profit. So you can see how much does the debit spread actually make. So over here, you can see that the debit spread itself is $7 wide. So this is how you know how much max profit you can get. So if it's going to be $7 wide, your max profit is pretty much going to be around $700 or so. So if you're going to take about maybe 80% or 90% of this $700, then you're going to get roughly, if my maths serve me correctly, it's roughly going to be around maybe $600 or maybe $500 plus, depending if you're going to go for, 80% or 90%. Okay, so how do you actually manage this? So this is the key of what you're going to do when the market actually comes down. So first of all, if the market stays above this whole structure, the market is above down here, do nothing. They'll all just pretty much expire worthless, and you already received this upfront credit anyway when you put on this trade. But what if it goes down? So when it goes down, this is where it's very important to know how to manage it. So if it goes all the way down, way past your cash secured put, this is where you want to manage it separately. That means to say the first thing you want to look at is this put debit spread down here. So this put debit spread, this is where you want to monitor it under your positions tab to see what is the profit. So once it reaches around 80 to 90% or maybe even 70%, this really depends on you, close out this trade. So once you close out this put debit spread, all you're going to be left with is just this cash secured put. So let me just remove this two legs down here to just show you what we left with. So once you're left with just this, then it's going to be like how you manage the cash secured put if you did the traditional wheel strategy. So two things you can do. Number one, you can just leave it to expiration. And this time you're going to be assigned the 100 shares. But now, because you have the added profits from the put debit spread, you're going to have more money inside your account. Because if you just did the cash secured put by itself, it's just going to be only $230. That's the premium you receive for selling this. But once you have the put debit spread and you close it out around 70, 80, 90%, you're going to have much more. Okay, so the second thing that you can do is actually to roll this out. So to roll this out, you simply just have to do this in one order ticket. Now, I already have a separate video to talk about rolling the short put, so I won't go into much detail here. But basically, what it's going to be is you're just going to be closing out this position. And then on the new DTE, so during that time, you want to roll it to somewhere further out, you're going to choose a strike price that is going to be lower than the $100. So maybe somewhere 97, 96, depending on what you can get then. And then you want to see the overall net credit. So you want to get a net credit when you are rolling the cash secured put. So again, I've already created a video on rolling. I call it the short put rolling masterclass. So you can go over to my channel to look for it. So this is how you construct the put ratio spread. So now, lastly, I'm going to talk about the call side. So the call side is pretty much similar as well. So once you assign on the $100, and now you've got 100 shares, this is where you can start to sell the call ratio spread. So for the call ratio spread, it's going to be pretty similar as well. So let's just go to around at the money again. So same thing. This is where you want to decide on the price where you want to get called away, or rather don't mind getting called away. So at the point of time, you're at the money, as you can see over here, this line is going to be somewhere around here, depending on where the price is. So let's just assume right now the price has gone up to 114, and then now you're putting on the call ratio spread. So by putting on the call ratio spread, you start off with the covered call first. So maybe in this case, so let's just say, for example, you don't mind getting called away at 125. So you're just going to select the bid side on the call. 3.35 is the premium. So you're going to use a part of this to finance the purchase of the call debit spread. So I think I mentioned just now that there was two ways to construct this ratio spread, and I forgot to mention the other time. So the second way, you can just have two call options down here, two short call options. You see the total premium, and then you just find one that is less than 9.77. So in this case, you can see that at the money is 7.75. You can just click this, and overall, you're going to have a net credit. So similarly, same thing. So if the market or NVIDIA is going to go above this, then all you got to do is close out this call debit spread first, take some profit, maybe about 70 to 90% again, and then you're going to be left with just one cover call. And for this, either just let it expire so that maybe it get assigned and then you get your shares called away, or maybe it goes below the expiration and then it expires worthless, then you can do the call ratio spread again. Or the next option, of course, is you can roll the covered call that is left. Okay, so this is the alternative way that you can trade the wheel strategy. And as you can see, because of the embedded debit spread that you have in the put ratio spread and the call ratio spread, it's going to help you at least feel better if the market is going to move beyond your covered call or your cash secured put. Now, there's going to be some trade-off, of course, compared to the traditional wheel strategy, not necessarily one that is better than the other, but with this version, at least if the market crashes like what has happened in the past few weeks, you're going to feel better because you're going to have the put debit spread that's going to give you a much larger profit on the way down. And if the market is going to have a very huge rally past your covered call, then at least you're going to be incentivized through the embedded call debit spread as well. So hopefully you'll find this video helpful, and if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to my channel for more options trading video like this, and I will see you in the next video.